It's Saturday, March 28th, 2020. Just want to do a quick video here to help those of you getting the signals or want to get the signals on how to place your orders and to give you a few tips on taking the signals. Okay, like here's an example of what these signals look like. This is the signal room for the Code 7 Dow futures. And let's see here, this was actually the signal right here, this part of it. And it says 327.20 pending YM long signal at 21,920. Stop minus 610 ticks. Profit plus 120 to 280 ticks. I had gotten 120 on this one. I took it at the last. Well, I didn't take it at the last minute, but what happened is it broke long and it went long. I mean, it hit this price, and then it came back down a bit, about 150 ticks or so, maybe even 200 ticks, and that's where I got in at, right down there, and then rode it all the way back up for the plus 120. So I actually made more than 120, but I had just called it 120 because the signal, most people, if you set up your order, it wouldn't have went off right here. And if I was wanting to take the trade, I would have taken it right here at 21,920. But I wasn't going to take it. I only took it because it gave the opportunity once it went back 150 ticks, and I'm going to teach you about that a little bit here. Okay, so this is what the signal looks like. And so what you're going to do is you're going to set the pending order is a long signal. So a long signal, you're going to use a buy stop if the price is lower than this already. And these signals, the vast majority of time, at least 90% or more, 95% even, you will get the signal in advance so that you have time to set it up on a sell stop or a buy stop. In other words, the price will be forward of where it is. You won't have reached the price yet, whether the short side or the long side. And then you'll get it and you'll have the opportunity to set it as a buy stop or a sell stop so that the price, you'll enter at that price. So let's say you wanted to go long at 21,920. Let's go take a look. That's the signal, 21,920. That was actually here yesterday on the chart. And it was only good for a little bit, like I had said. It was good for about, let's see, 920. It went up to 22,183. So 920, 20, 120 was worth 260 ticks. 260 ticks. I took 120 ticks out of it. And if you had read the signal that I had sent out, you see that I said be very careful with this one because it could come down. And it did indeed come way down. But the signal was good. Anyway, so this is how you would do it. It's very simple. Let's say we were going to do it here at 21,920. All you would do is come over to your order, use a stop, place your quantity, whatever you want. I have it at 1, and then the stop price. So you're going to put it in 21,920 or whatever it is. Now, make sure that this says good till canceled, not day. Put it on good till canceled, GTC. Set it for trigger outside RTH. That means trigger outside of market hours, basically. Click on the advanced. It brings up this. Attach stop and profit take bracket. Click on that. It brings up this. Click on this right here, bracket profit taker. It now selects both of them. You have a profit taker and a stop loss. Now you just need to set the price. Okay, so 920, I went for 120 ticks, so that was 22,040. That's 22,040. That's your profit. Click over here. Make sure this is good till canceled. Stop. Now you have to calculate the stop, but let's just go ahead and say 920. Put it at 21,400, whatever it was. 21,400. Whatever the stop was, you'd have to read the signal and just place it What you'd have to do is, sometimes I give the exact price, sometimes I give just ticks. And so what you need to do is, if they say like 500 ticks, you calculate minus 500 ticks from 22,040. If you need to use a calculator, do it. Just put in 22,040 and then put in minus 500, and you'll see what you get. And then you can use that number as your stop. Make sure this says good till canceled, and make sure trigger outside. The RTH, make sure that's selected. Always make sure you do that. And good till canceled. And that's all you got to do. And you just come over here, click outside. It's ready to go. You've got a bracket order set up. There's your bracket. You can see what it is. Let's click on it again just to check it. Okay, there's your stop, 22,000. I mean your limit, 22,040. It's 120 tick profit. And there's your stop, 21,400. Whatever the stop was, we'd have to go read the signal again, but it doesn't matter. Whatever the stop says it's going to be, or whatever you calculate it to be, if it's minus 500 ticks, minus 600 ticks, whatever it is, just get a calculator out. Put 22,040 minus 500, and you'll get your number. And then go ahead and put that number in for your stop. And that's it. That's all you got to do. And then all you have to do from there is, this is going to be a buy stop once the price reaches 21,920. Now the price right now is 21,410. So if it goes up to 21,920, you will get in going long. You can do the vice versa if it goes down. So if we were here and we wanted to go short at 21,300, we would put in a sell stop. So let's go ahead and put in this buy stop. We've got it all set up. All we got to do now is hit the buy button. Okay, so now you see these orders come up in two different places. One here on the chart, and in order to see that, you would have to come down here and click on Chart Trader, and then you'll see this information down here. Otherwise, you would just see it here in your active orders. And we have got a buy stop at 21,920. We've got a sell limit, which is the profit, at 22,040, and we've got a stop loss, a sell stop, at 21,400. These two orders are child orders underneath this order. So when this order gets filled, these two orders will become active. If one of these orders gets filled, the other order will automatically be canceled. So you won't have another order out there sitting that will get filled if you don't cancel it. This is why you want to set your orders up in advance like this, and not set them up afterwards, because if you set them up afterwards and then you don't know how to do the other cancel order, automatic cancel order, if one gets filled, the other one gets canceled. If you don't know how to do that, which is kind of an advanced thing to do, then you're going to have an open order out there that could easily get filled that you don't want. So I recommend just setting it up like this before you get in. I will give you enough time to be able to set this up. The vast majority of time. Not always, but usually I can. And you can set the order up all in advance, ready to go, so that when it goes and it hits, everything is already set up for you. And then once it goes off down here and it's in, you can adjust it. So you can change the price right here and change these prices, and then update right here. It'll say update, and you can update it and it'll go and change the price for you. So you can change the stop, you can change the limit anytime you want once they become active. They don't become active until the buy order becomes active. Then these will become active. So that's how easy it is to do it. Now let's go ahead and cancel these. All you got to do to cancel all of them is to cancel the main one. So the main one is the first one, the parent order. Hit cancel. And then it will cancel everything. So let's say we wanted to set up a sell stop. Let's go find one in the signals. Actually, it doesn't matter because they're all going to be the same. So let's just set one up. Let's say the sell stop is at 21,200. So all we're going to do is click here, put on stop, quantity. These are your contracts. Use as many contracts as you want. And then the sell stop, the signal comes through So today's date pending, or yeah, today's date pending YM short signal at 21,200. So you're going to put in 21,200 as the price, and make sure it's good till canceled. Make sure it's clicked on trigger outside and you can set this up in presets, by the way, so it automatically fills out most of it. Good till canceled, uh, automatically triggers outside of hours, what your contracts are, if you want to start off with a stop order, anything you want you can do in the presets right here. So let's click on advanced, click on the bracket again, go to the limit. How many ticks do we want to get? We're getting in at 200 short. Let's say we're going to go for 200 ticks. So we're going to go for 21,000 even. 21,000. And then the stop is going to be, let's say the stop is 500 ticks. So we're getting at 21,200 short. The stop would be at 21,700. So we'll put that in, 21,700. Click outside of it. Make sure this thing is triggered. Trigger outside RTH and good till canceled. Don't do day. Make sure it's good till canceled. You should go in to the presets and set that up so it's good till canceled automatically so you don't make a mistake. Okay, everything has set up. Click out of there. It's ready to go. Bracket is ready to go. Now all you need to do is hit the sell button. Just like that. And so now we have a sell stop in place at 21,200. So once the price reaches 21,200, which is right here by this red line, by the way, and if I wanted to, I could grab a hold of this red line by clicking down the mouse and moving it down or moving it up. I don't recommend doing that because it's very sensitive to do. It would be better to just do it right here, or the sell stop right here, and just move it there, or move the stop, or move the limit by the price, and then update it. Okay, so we've got a sell stop, and then the buy limit will be at 21,000 for 200 ticks, and the buy stop is at 21,700 for minus 500 ticks, whatever the signal is. This is how easy it is to set up your orders. And this is the way I recommend to set them up, so that there's a parent order and 2 child orders, and everything will be taken care of automatically. If one order gets filled, the main one, these 2 take over. If one of these get filled, if your limit gets hit or your stop gets hit, the other order automatically gets canceled. And you really want to do it that way, because I've done it the other way and had orders go off that you didn't want to have go off. So the best way to do it is like this. Alright, so let me give you a few pointers, a few tips on taking the signals. Okay, now if you get the signal and it's during market hours, which it always basically will be, and you get a signal and it's still during market hours, the market has not closed, and then the signal gets activated, in other words it triggers, it goes off, it hits the sell stop, it hits the buy stop, and now you're in the signal while the market is still open and there's still some time left in the market, let's say an hour left or maybe more. These are your best signals. These signals usually will be good for a good amount of ticks, sometimes a very large amount of ticks, especially if there's a lot of time left, like 2 hours left in the market before it closes, or even 3 hours left in the market before it closes. Sometimes even more than that, but let's just say it's like 3 hours left before the market closes and the signal gets triggered. Those are usually the best of all. You could look for some big trades on that signal. And you can also look for it to just keep going. Once it breaks, or once it hits the price and you're in the signal, then it's basically just going to keep going. I mean, it may go against you a little bit, but not a whole lot, and then keep on going. Those are usually always the best signals that get triggered during market hours and there's some time left. Now, if there's very little time left in the market and it gets triggered, those are not so good. Not generally speaking. I mean, they're still good signals, don't get me wrong, but they can go against you for a ways. Okay? And so that's what we're going to talk about next. If you are you get a signal and it doesn't get triggered during market hours, there is the very real possibility, and mathematically speaking, a lot of times will happen, that the signal will trigger and you'll be in the signal at that price. But what it'll do is it'll go against you in the signal by about 100 to 150 ticks on average. Let's just say on average between 100 and 200 ticks on average. It'll go against you. And so it does this a lot. It does this actually quite often, especially if it does not get triggered during market hours. It will go against you. Not all the time now, of course, but it'll go against you about, outside of market hours, it'll go against you about 70% of the time, I would say, roughly, outside of market hours. Now, during market hours, it'll only go against you 100, 200 ticks, maybe about the same, about 30% of the time. 70% of the time during market hours, it'll just keep going and be good. But 70% of the time outside of market hours, it's going to go against you. And once it triggers, it'll still go against you a ways. So what you could do is you could actually anticipate that if you wanted, and you could wait for it to go against you by 100, 150 ticks. 150 ticks is about average. Sometimes only 100, sometimes even 200, but about 150 average. So once it gets about 150 ticks going against you, you could take position right there. And you're going to hit it a lot of the times. If you just pay attention to the signals now and pay attention to that pattern, you'll see what I'm saying to you is right. And you'll be able to start catching them. Happens a lot. Let me teach you another good technique. Sometimes, right lately, okay, the market has really been moving a lot, and this hasn't been happening very much. But sometimes it will go just a little bit in the signal. So let's say the signal was to sell short at 21,200, and this is here at this red line, and it goes in and it gets you in, and it just goes down a little bit, like maybe 30, 40, 50 ticks, and then comes back against you and starts going up. Okay? Sometimes they'll keep going. It doesn't happen that often. But what you can do is you can wait for it to break, wait for it to come back, and then wait for it to come back down again and break. If it does that, the mathematical chances of it continuing are extremely high. I would say 98%. Let me say that again. It comes down, it gets you in short, it hits your sell stop. Now you're in the trade going short. It only goes about 30 to 50 ticks, sometimes a little bit more, 70. And then it goes back the other way on you right away. Right away. Almost immediately. It's going to go back up again. Sometimes it goes way back up again. Doesn't hit the stop, and then turns back around and comes all the way back down. Sometimes it goes all the way back up and it'll go and hit the stop. Now, it only does this a small amount of time, but it has not done it since I've been sending out the signals, but it does do it, mathematically speaking. Now, I can avoid some of them because I can see them coming, but sometimes I can't, and sometimes we do get caught into them. It can happen. Usually when it happens, though, I can tell, and I'll send out the signal to exit the trade for a loss. Just take the loss and get out. Sometimes I can see it coming. But here's a technique that you can use. It goes and breaks, goes down a little bit, comes back. Now you've got two ways you can go. It comes back up. Now you can take your position here and go short and write it back down again. Or you can watch it go back down again and break the previous low that it had made. It broke, went a little bit lower, 50 ticks lower, then went back up again, then comes all the way back down and breaks that low again. If it does that, the mathematical chances of it continuing to go down is about 98%. In other words, it's almost guaranteed that it will continue to go down. Or if it were a long signal, it would do the opposite. It would go and break higher. Let's just say this was a long. It will go and break higher, then come back down, and then go back up again and break the high again, and it'll continue to go up at that point. So that's a really super safe way to play the signals if you wanted to. Maybe that would be like an ultra safe way to play them. If you wanted to just play the signals with 100% success, you could play them like that. Problem is you would miss some of them. Some of them would break going up or break going down. They would just keep going. If the signal comes during market hours and if the trade is triggered during market hours, just take it. Just take it, because if you don't, 70% of the time you're going to miss it. 70% of the time you will miss it. So just take it. But if it does not trigger during market hours, about 70% of the time you can get 100, 150 ticks better entry than you would just taking the straight signal. Now that does mean, though, that 30% of the time you're going to miss them. And when you do miss them, the problem with missing those is those are usually also the best. In other words, they go a long ways too. So it's a plus and minus on how you want to go about trading the signals. But let's say that you got the signal and there was no way that you could take it at the time, and you go and look at it, and when you look at it, it's about 100, 200 ticks better price than what the signal is. Take it. Go for it. You're getting a really good price. Go ahead and jump in. It does it all the time with the code 7 signals. Let me just say that again. With the code 7 signals, it does that all the time. With the code 5, it's different, and you would not want to play the code 4 like that at all. So those are completely different. I am talking about mainly the code 7 signals here on the YM and the HSI. Both of them are pretty much the same with respect to each other. They both act the same. So if I'm teaching you for the YM, it's pretty much the same for the HSI. One thing I would like to say is that it takes a little practice to set up your orders. And at first, it's going to seem a little bit cumbersome. And it's easy, very easy, to make a mistake. You really need to practice setting up your orders and making sure you've got the prices right. Check it, double check it, and triple check it. Make sure, step by step, you've got a sell order, quantity, you've got a good till canceled. It's a stop. It's a sell stop. The price to sell is 21,200. Check. You've got a buy stop. Good till canceled. Quantity 1 at 21,700. Since you're going to go short, this stop is proper. 500 ticks above. Make sure you do the math that I send to you and place it right. Check it. Double check it and triple check it. Same thing. Buy, good till canceled, 1 contract, limit order at 21,000. This is your profit. 200 ticks, 21,200 down to 21,000 on a short. Is that correct? Check it, double check it, and triple check it. When you've checked it all and you've got it, you let it roll. If you make a mistake, it can cost you money. So do your very best not to make a mistake. Also, about placing stops. I know some of you have had trouble with placing a break-even stop on the signals. You have to try to understand one thing, okay? Right now, and I've sent out a lot of signals. I don't know exactly how many. I'd have to go and count them, but there's quite a few, and it is a 100% success rate right now on both the HSI and the YM. It's an absolute 100% success rate. So, with that kind of mathematical success rate, you don't need to overly worry about a protective stop. However, the market is really moving, and it can really move a lot both up and down. I can't tell you how many times I have been up 3, 4, 5, 6, 7, 800 ticks. I'm just talking about over the last 3 weeks, that many ticks. And I go downstairs just for a few minutes and come back up again, and I am already back to break even again. And just, shaking my head like, what happened? I mean, I really thought I was sitting in a great position, and all of a sudden, it just comes right back up on me. So fast, and it has done it more times than I can count. I could really kick myself for not taking a lot more profit off the table than what I could have taken. And it's been a little bit tough for me because I haven't been taking anywhere near as much profit as I should have. It's I have nobody to blame but myself, but I have taken plenty of profit though, so it's not like I'm complaining or anything like that. But my point though is that if you place a stop and you lock in profits, or at least you lock in so that you're not going to lose, you won't get stuck like a deer in headlights when something happens in the market and you freeze. You freeze and you say, why is it shooting up like this? Oh, now I'm down 50 ticks. Oh, now I'm down 200 ticks. Oh, now I'm down 600 ticks. What's going on? Now I'm down 1,000 ticks. It can happen. It can absolutely happen. I've seen it happen many times. And you get stuck because you didn't want to sell at 50 ticks because you're wondering what's going on. Am I really seeing this? Is it really going up all of a sudden? And then all of a sudden it'll be 250 ticks. Oh my God, I'm losing so much money. And now you're really not going to sell. And then boom, before you know it, you're down 1,000 ticks and your whole account is gone, wiped out in 30 seconds. Don't allow it to happen. Once you get ahead, let's say it goes 100 ticks ahead, 120 ticks ahead, you really do need to place a break-even stop on the trade. And a lot of times it's going to come back and get you, and it's still going to go. You'll need to get back in again. You'll need to follow it. Or you'll just need to see what it's going, and at first just go for 120 ticks. Start building it up. Just take 120 ticks per trade. Build up your account. Now you got your account built up, you can afford to be a little more, open up a little bit. And then you can start going for more ticks. You can start going for 180 ticks per trade. Now you open up, start taking more profits. And then you don't actually need to go up in ticks if you don't want to. You can just go up in contracts. Like for instance, you could just take 120 ticks off of every trade. Your math is really super high. Your math is above 70%. It's well above 70%. Lately, it would be at 100%. Yeah, lately, because you got to remember, the market is moving a lot more than it normally does. So 120 ticks is like 100% right now. But normally it wouldn't be. Normally 120 ticks would only be about 70%, perhaps 80%, maybe. Yeah, I'd say about 80%, actually. 80% of the time, you're going to get that 120 ticks. Okay, that's good math. Now all you do is up your contracts. Now you double your contracts from 1 contract to 2 contracts. Now you make double the money. Now you go to 3 contracts. Now you go to 4 contracts. You're making double what you were making at 2 contracts and 4 times what you were making at 1 contract. So it just becomes about contracts now at that point, not about more ticks. And your math is really super high. That is a fantastic way to play. I highly recommend that way to play to all new traders. Just play that way. Then you won't have to worry very much at all, and you'll be out relatively quickly. And you'll build up your account. Now, once you start building up your account, Now you can start really opening up, because every day you can see how many ticks the signal was good for. Every day. See how many ticks the signal was actually good for. And you will see that there is a pattern to it. That, relatively speaking, it's going to go the same amount of ticks, which it's been averaging about, well, on the YM, I'm not sure exactly, but it's been averaging 500-600 on the HSI. The YM, I'm not sure. I think it's been more like about maybe 400, but it only did 260 on this one. And I didn't think it was going to go up very much either, and I said that in the signal. In fact, in the signal, I actually said I wasn't going to take the trade, and I wasn't. But it came all the way back down, 200 ticks about, and so I said, oh, 200 ticks, that's exactly what it does. And so I bought, and I got it right exactly, you know. Just happened to get it right perfectly. But it was only because it does the same thing over and over and over again. And if you just look at what I told you to go look for that, you will see it does it all the time. If you just took those trades and just took those trades alone, you would do very well. Again, however, during market hours, don't play that way. Just get in. You don't want to miss it during market hours, and go for the bigger trades. Don't just go for 120. If you get the signal during market hours and there's 1 hour, 2 hour, 3 hours left before the market closes and the signal gets triggered, do not go for 120. The signal is likely to do a bare minimum of 225, if not 280, if not 380, if not more. 4, 5, 600. Actually, a signal usually during normal market, not during this market right now, but during the normal market, a signal rarely ever goes over like 540. Yeah, rarely ever mathematically. Only doing it right now because the market's moving really big. So you want to, during normal market, which of this market will go back to a normal market in time. I don't know how long, but it'll go back in time and stop moving so much. You basically only want to go for 180 ticks on the YM, and for the HSI, 225 ticks. You can hit that most of the time. So, but if you back off to 120 on the YM, you can hit that the vast majority of time, most of the time, and on the HSI, you can hit it almost every time. Yeah. See, because the HSI moves more ticks. So you can hit it almost every time on the HSI, even during the normal market, 120 ticks. So you just do the math. Do 120 ticks times $5 is how much money? And then do 120 ticks times $10 is how much money? 2 contracts would represent $10. And then 4 contracts, $20. 5 contracts, $25. $25 times 120 ticks. You just keep doing it that way, keeping the math high and making your money. And you get a signal almost every day. If you need to make more money, well, get 2 signals then. Get one for the YM, get one for the HSI. Or if you don't want to wake up in the middle of the night, I perfectly understand, get something else. Get a currency, code 5 currency. I'm going to show you soon how to use TransferWise to put some money into, and then use the code 5 on the currencies, like the Euro US dollar for instance, and sit there and just go back and forth between the currencies. So when the Euro US dollar goes long, you put your money into the euro. When the Euro US dollar goes short, you put your money into the dollar, and you just keep switching it back and forth with the click of a button. And every time you get a code 5 short or code 5 long, you switch it. You can make a lot of money like that, and you will never be in a losing position, or you'll never write a currency down. You'll never have a currency crash on you. And I'm just telling you right now, giving the warning, the dollar, you really feel bad that the dollar is not going to make it. I don't want to sound like an alarmist, but I have real reason to believe that. It's not about Peter Schiff and all these other people talking about it, Gerald Celente and all these other people. No, it has nothing to do with them. It has to do with something else. And I really think that I've got a code 5 short signal on the dollar now. It was long and it went code 5 short. I don't know if it's going to switch again. It might. I think as the market comes down and crashes, the dollar might switch again and go back up. I'm watching for it now, and I'm looking for a code 4, and I'm wondering if I should just get out. But if it does start coming down more, I will just get out. I'm going to switch over for the dollar. But I didn't get out on this code 5 short, and it has really gone down big. And I'm really kicking myself for not getting out. I should have. And I realized that I need to be more nimble and just be able to get in and out on every code 5. Just every one of them, because it's really moving. And like for instance, the last code 5 on the Euro US dollar, I mean, this thing has shot way up. So anyway, I will teach you about that, how to use TransferWise. You can protect your money, and you can also make money too at the same time. As far as holding your positions overnight, you need to make sure and double check your margin. You need to have more of a buffer than what you think that you need to have, because if it goes against you, and it goes against you well, 200-300 ticks, let's say the stop is 500 ticks, and it goes 250 ticks against you, or even 300, even 400. It can happen. It does happen sometimes, not very often at all, but sometimes it does. The only time it's ever even come close to hitting my stop before was on a code 4 signal. A code 4 signal, it almost hit my stop. Came like about 4 or 6 ticks away or 7 ticks away. I don't remember exactly, but it came very, very close. And it was a big one. It was 1,000 tick stop. Yeah, 1,000 tick stop. And it came really close to hitting. And it didn't though, and it went all the way back up, and I made 1,000 ticks on it, or I made 900 ticks on it. I made a 900 tick trade, but it came very close to stop. My point is if you don't have enough in your account to ride the margin out, it goes against you that much. What will happen with Interactive Brokers is they'll automatically sell you out of your position, and you'll take a huge loss. So you really do need to be careful. If you cannot hold overnight, then it's very simple. All you do is just play the signals that trigger during market hours. Of all of the signals that you will get, only about, let me see here, only about maybe 30 to 50% of them will trigger during market hours. Only about 30 to 50% will trigger during market hours. Okay, so you're only going to be able to take those signals. The good news is that the vast majority of time, those are really good signals. They'll really move a lot. So you can basically go for more than 120. You should go for 180 at least on the YM and 225 at least on the HSI on those signals. And that's just to start off to build up your account. You can go for more than that. You should be going for, I would say, at least 280 on the YM during those signals that come during market hours, especially that have a lot of time left. If it only has 30 minutes left, that's different. Just go for 120 ticks. But if it's got an hour left, 2 hours left, especially 3 hours left, jump all over it. Take 280, no problem on the YM. 200 on the HSI. You should be able to basically get 280. You should be able to get, like, I think 380 on the HSI. 380 during market hours. If the signal comes during market hours, you should be able to get it pretty much. You can back off to 280 as well on the HSI. It'd be real good math. So 280 on each one. So you're only going to get the signal 30 to 50% of the time during market hours, not hold overnight, but they're really good ones. Now you can also wait till the market closes, then take your position. You'll have to just play with, make a smaller amount and just play the signal. You could just play the signal, and then it'll go, and then you get back out again. That's fine too. It's just that you need to realize that when the market closes, your margin requirement will go way up because you're now holding a position outside of market hours. So you need to account for that your margin requirement will go way up and that it can go against you. And when it goes against you and your margin requirement goes way up, Interactive Brokers the computer will automatically close out your contracts on you. Now, other brokers don't do this. Interactive Brokers does. A lot of people complain about that, and it is something to complain about. So if you are going to use them, then you need to understand their rules and how they operate and work within that. And so, at first, you can just start off with, one contract, keep it real small, and work your way up. Just build your way up, slowly but surely. And also, just taking 120 ticks on every trade will get you in and get you out. You take your profit. Get you in, get you out. You take your profit. Every time. Get you in, get you out. Take your profit. Up your contract. Double. Get you in, get you out. Take your profit. And keep doing that. And then just keep, as you make enough money, you go up at one contract. Every time you go up just one contract, you are making a lot more money automatically. There's no reason to push it too much, too fast. Just keep going at a slow but steady pace. And you will be making bank in no time. So that's basically all it is, and that's how simple it all is. And don't get too greedy. Don't go for too many ticks. But see, here's the thing. I just want to point this out. Here's where I'm at. You build yourself all up. Now you're playing at 10 contracts, making $50 a tick, right? And you know when to go for it more. And now all of a sudden, instead of doing 120, now you're doing 280 ticks at that higher level, at 50. And now all of a sudden, you're really making bank. And then you can double that to 20. Now you're making $100 a tick, and you're hitting 280. Now you are really making bank on every single signal. So, I know it's sounds incredible, and you know why? It is because it is incredible. Even I am amazed by it. And that is why I will not teach it to anybody, because if I teach it, it will stop working, at least as good as it does now. And right now, I have 100% accuracy. And if you don't mind, I don't want it to stop. And I don't think that any of my clients want it to stop either. And so I think I'm doing the right thing by not teaching it, sending out the signals, allowing everybody to make money on it, including with myself. And we're all extremely happy with this. Everybody, I think, is extremely impressed, and many people have written to me to talk about how accurate the signals are. Well, and they are 100% accurate. Anyway, I really hope that this video was useful to you. If you have a question, ask in the comments below, and I'll do my best to answer it. And I'm trying to help you to learn how to play these signals better and how to do your trade so that you're successful on your end. And I will do my best, of course, on my end to help you to make as much money as possible. And as you can see, I'm pretty good at it, and only because I've broken the codes. But hey, what works works, right? That's all that matters. So anyway, I'm going to get going. Hope all of you traders are doing well, and I hope you're loving the signals, and I will see you for more trading signals. Happy trading.